Hello, this is the chart profit video shortly after the open on 1st of June. This from the pre-open today. We're looking at the Emini SP. We had a pretty positive day on Wednesday. If you remember 1 week ago on Friday 25th, the 12-month controlling price migrated up to here 27.18, and then on the Wednesday Emini managed to print most of its value area here back above that level, and we had aggressive buying marked, and that was all pretty positive. 8 times out of 10 this green at top high has exceeded the following day. In fact, we had a disappointing day on Thursday. We had a lower value area, and we just saw a very brief test over here of that low on Wednesday, which kind of negated the positive implications of this bit here. So basically I said pre-open today that overnight the E-mini had actually rallied back to just probe up into that controlling price at 27.18, but we need to see time printed back above that level now to put the E-mini back in a strong position. So just after the open today, this is the first half hourly 30-minute bar here. So far so good. We're printing above 27.18. More time spent above this level the better. Okay, so just before we review the current chart, so let's have a look at the sentiment indicators. This is my version of the RIDEX assets ratio. As you know, a couple of days ago, Tuesday, it reached 24, which was the highest level since back over here in early February, and there's only 6 readings of the ratio above that in the database. So this is actually an extremely high reading currently, up around 24 for the ratio. And if we see February's high exceeded, that would really put us into or back into extreme territory. That was obviously the ratio that coincided with the top in the market at that point. Public poll from AAII sits in neutral territory at the moment. Last significant readings we had was back over here 7 weeks ago. That's where the bulls percent fell to 26.1%. That was the lowest since September, and the bears percent reached 42.8%. and that was actually the highest since March 2017. Currently, if we look at the net, it's at 8.6, that's the bulls minus the bears, but that again fell to a negative 16.77 weeks ago. That was a 2-year low. So at this point in the market, we were getting some pretty high readings from the bearish camp. Market has rallied back from there. Same thing in the investors intelligence poll. 7 weeks ago, bulls percent fell to 42.2, which was the lowest since November 2016. And actually just 4 weeks ago, the bears percent reached 20.8%. That was the highest since December 2016. And just regarding the black line that we see here, which is the 4-week moving average of the bulls minus the bears, which is always worth following. Just 3 weeks ago, that fell to 24.4, and that was the lowest since November 2016. So again, in here, bears very evident. And we're looking at LIPA US fund flows data. Had a net inflow this week to the 30th of May of 4.9 billion. Indicator to watch on here is the 4-week flow. That's the black line, currently at 18.47 billion. But again, 7 weeks ago, that fell to a negative 29.9 billion. That's a really low flow number. That was the lowest since this point here in December, a negative 33 billion, and that was the lowest since 2008. So these two readings here extremely low. And again, 7 weeks ago in here, all 3 indicators showing unusually high levels of bears. And just to remind ourselves once again, these are contrarian indicators. Okay, we're looking at the current chart for the spider, just opened in the last few minutes. Spider sits in pretty strong price location. 2 reasons here why this is not a bad looking chart. Firstly, we just always look at the halfway point from an important high, which is this dotted line here, and apart from this probe earlier in the week, all of this consolidation here has been above that level, which is usually a good sign. And this week, just in the last couple of days, the 18 months controlling price has moved to 271.70, and we're currently printing above that level. Market has been led higher by the small caps. The Russell 2000 here, IWM, and as we know, that's broken out to a new high recently. And again, earlier in the week, that previous resistance here and here became support, and then the market has, or the Russell has actually broken back above that earlier peak here. So we are holding currently the breakout to new highs, which is a good sign generally. Been a lot of talk about the small cap indices being unable to pull the large caps higher, but as we've just seen on the spider chart, sits in a pretty strong position as we speak. UK's FTSE 100 has had a tremendous rally since the March low, has actually exceeded the previous peak earlier in the year. Unlike the Russell, didn't find support there. We're just printing back below that level at the end of the week, just attempting a rally back. So the German DAX index, I'm looking at the halfway point between these two, from this high here to the subsequent low, and that comes in around 12,650, this dotted line. DAX at the end of this week holding that level. That's the best support I've got, which is local on this chart. I've noted that this 2-year controlling price at 12,240 could actually move higher. Hasn't done that yet. That would be interesting. Looking at bonds here, this is TLT, quite volatile to say the least over the last couple of weeks. Since the high back over here, we hit a new low at this point in May, which was a test of the February low over here. That was rejected, and we saw a terrific rally back above the really important level at 121, which is a major controlling price. Held that for a couple of days, and we're off quite sharply at the end of the week here. And for bonds, this is really the level to watch, 121 for TLT. Really looking for a clear higher low above that level to really strengthen the bullish case, but we're, as I said, we're printing back underneath that, just retracing a little of the rally we've seen from the March low, but that's what I'd be looking for going forward. Okay, this is GLD, the gold ETF. Coincidentally, its major controlling price at 121. GLD printing above that, so I'm saying in the longer term this is still a strong price location, off a little bit at the end of this week, but clearly a better level can be seen here on cash gold. We're looking at 1286.50, which is the major support. We've just briefly tested that here, but generally this has held. Price printing time back underneath that level would really weaken the situation for gold in my view. This is USO, the oil ETF. This was the highest level the chart has reached since November 2015, off quite sharply from there. The big support longer term is the 12 months at 12.79. Okay, the dollar index. As we know, in April, the major migrated lower down to 89.54, this level here, and shortly after it did that, the index started rallying, and pretty much has been rallying ever since, just retracing a little bit this week. The previous controlling price, major controlling price, was at 95.50. That may well still be resistance should we reach that level. And the mirror image of that, almost the Euro FX chart, where the major migrated up to here at this point in April, 123.30, and this chart has been heading lower since that point. The 1 year at 117.55 could have provided support and it didn't. That is now resistance on this chart. Currently we're printing below that level. Remains a weak chart in my view. Just a little recap on the British pound chart. As we know, these two peaks here and here were actually a test above a really major value area high going back years. We've discussed this before. It's quite a sharp rejection from this point, and then we broke below the trend line here off the 2016 low and the acceleration lower. Been looking at the chart on various time frames, and on the daily we can find major support here at 131.70, just below the recent low we had this week. Price printing time below that level would put the pound in a really weak position. Okay, the dollar yen, 113.70 is the major up here. 2 year controlling price is here, actually emerged in here, 111.30. We've seen a rally back to that point and just a probe into it, and that's been rejected. It leaves the chart We say okay, it's below the major, it's below the 2-year, so that's a weak price location. We're holding the halfway point off the low. So we just retraced almost half of this rally. So in terms of trend and long-term positioning, it's the most unclear to me out of the charts that we've just looked at, the last 4 or 5 currency charts. Price back below this minor half here, which is currently about 108. Definitely put it back in a weak position, but currently we're holding that. You always mark the halfway point off an important low to the subsequent high. Currently we're holding that, as I mentioned, so in the short term the chart looks okay here. Just a quick look finally at some of the charts from last week's ebook. So they were looking at last week's commitments data. New set of data out this evening, so it'll be interesting to see how these charts change. But the S&P 500, and this is the large data that I'm looking at for the large contract, smart money commercials here at quite a bullish extreme, and the small traders pretty negative. So I think this looks pretty positive for the market. Unusually so does this chart here, which is the commitments for T-bonds. Same thing, the commercial smart money very bullish, the large speculators and the small traders pretty bearish. Seeing the same thing in the gold data. Most important to me in my analysis are the controlling prices and where price sits relative to those levels, like 27.18 on the E-mini, which has just broken above Wednesday's green at top high, and as we know, within 1-2 days it does that 80% of the time. So we had this brief test on Thursday which negated that strictly. I want to see the E-mini holding 27.18. Okay, that concludes, and once again I thank you for watching.